They told you that dumb money always loses. They told you retail investors are emotional, irrational, undisciplined, and destined to be the exit liquidity for Wall Street. But what if the truth is far more complicated and far more interesting? What if dumb money not only wins sometimes, but wins because it plays a game the professionals aren't allowed to play? In this video, I'm going to take you through the real mechanics of why dumb money occasionally beats Wall Street, something bankers never say publicly but talk about privately all the time. And by the end, you'll see the financial system in a completely different way. Let's start with a shocking idea. Dumb money isn't dumb, it's just uncorrelated. And uncorrelated is the one thing Wall Street can't model. Inside institutions, every investor, every analyst, every portfolio manager is trained to think the same way. They're using the same risk models, the same textbooks, the same optimization frameworks. They're evaluated the same way, judged the same way, and punished the same way. Their job is not only to make money, their job is to avoid sticking out. This creates an invisible force that drives professionals to act like a herd, even when they think they're being rational. But retail investors aren't in that herd. They have no investment committee, no quarterly reporting pressure, no clients demanding explanations, no mandate telling them they can't own a volatile asset or a tiny company or something brand new that the rest of the world doesn't understand yet. That freedom, something Wall Street people forget even exists, is one of the biggest hidden edges retail investors have. Because dumb money wins when smart money becomes predictable. And in modern markets, smart money is extremely predictable. Fund managers de-risk when volatility spikes. They reduce positions when models tell them to. They rebalance whether they want to or not. They hedge when correlations rise. And they sell assets not because they're bad, but because their spreadsheet says their exposure is too high. Retail investors don't have to do any of that. They can sit through chaos. They can wait longer. They can buy assets institutions are literally forbidden from touching. They can hold positions through panics, crashes, media fear cycles, and political noise. And they can do something professionals hate: nothing. Sometimes the most powerful advantage in investing is simply not being forced to act. That brings us to the big reason dumb money wins: irrational persistence. Irrational persistence is the refusal to give up on an idea even after the world calls it stupid. Institutions can't be irrational. Retail can. And that irrationality has been responsible for some of the biggest financial surprises in the last decade. Bitcoin is the perfect example. Every institution laughed at it for years. Every banker dismissed it. Every economist wrote articles explaining why it was worthless. And yet, it kept coming back. Not because the fundamentals changed overnight, but because millions of people, regular people, refused to let the idea die. Wall Street had no model for that. You can't quantify stubbornness. You can't simulate belief. But markets move based on both. And if you want an even clearer example, let's go to the most famous case study of dumb money overpowering the professionals: GameStop in January 2021. If you only saw the headlines, you missed the real story. Inside banks, the situation looked completely different. Hedge funds were not just short GameStop, they were structurally trapped. They had shorted so many shares that they created a system where the slightest coordinated buying pressure could trigger a cascade. And retail didn't need to be fundamentally correct, they just needed to be unpredictable. Wall Street builds risk models that assume investors behave in rational, measurable ways. But what happens when millions of people decide to be irrational together? You get chaos, and chaos is the one enemy the financial system cannot defend against. As the price of GameStop rose, institutions became forced buyers. Risk committees panicked. Prime brokers started making margin calls. Traders started seeing their bonuses evaporate. Fund managers were suddenly fighting for their careers. They didn't close their positions because they were wrong. They closed them because they had no choice. That's the thing the public never sees. Institutional investors often make decisions based not on markets, not on logic, but on survival. And retail investors, in that moment, had no survival risk. That's why they won. GameStop wasn't a victory of intelligence. It was a victory of freedom. Now let's zoom out and talk about the deeper truth. The real edge of dumb money is emotional freedom. Professionals are not allowed to be emotional, publicly, but behind the scenes they are terrified of volatility, terrified of losses, terrified of clients pulling money, terrified of being wrong in a way that gets noticed. Every institutional investor lives under the shadow of career risk. Retail investors don't. They're allowed to believe in a company longer than is rational. They're allowed to stay focused on a story rather than quarterly earnings. They're allowed to hold through a recession if they feel like it. They're allowed to take positions that make no sense on paper but perfect sense to them. And sometimes that freedom leads to returns no institutional portfolio can replicate. Let's break down the specific situations where dumb money actually has a structural advantage. First, long time horizons. Most professionals cannot hold on to a position for 5 or 10 years without being questioned. If a stock underperforms for 2 quarters, they get pressure. If it underperforms for a year, they may lose their job. Retail investors can ride out the entire cycle. They can buy something great, hold it for a decade, ignore volatility, and end up beating most professional funds without doing anything sophisticated. Time is the most powerful compounding tool in existence, and retail investors control it completely. Second, forced selling. When institutions reduce exposure, they don't do it slowly, they do it violently. And that forced selling creates incredible opportunities for anyone who isn't forced to sell. Retail investors who understand this dynamic can buy the bottoms that institutions themselves create. Markets don't always crash because things are bad. Sometimes they crash because someone big was forced to sell. Third, microtrends. Institutions cannot invest in tiny companies, new technologies, or unexplored markets until they reach a certain size. Retail investors can get in first. They can participate in early crypto projects, emerging industries, niche sectors, and companies too small for funds to touch. By the time Wall Street enters, retail investors are already sitting on huge gains. Fourth, simplicity. Professionals over-optimize everything. They build complex strategies, complicated hedges, sophisticated models, and then lose because the world refuses to behave like their spreadsheets. Retail investors can outperform simply by sticking to principles. Buy what you understand, avoid leverage, don't panic sell, and let time do its work. The irony is that the simplest strategies often beat the most advanced ones. But let's also be honest about the other side. Dumb money loses far more often than it wins. It loses when it chases hype, it loses when it becomes greedy, it loses when it trades without a plan, follows influencers, buys at the top, sells at the bottom, or tries to imitate Wall Street techniques without understanding them. Dumb money wins only when it stays dumb in the right way. Unpredictable, patient, unconstrained, emotionally free, and willing to hold longer than anyone else. The truth is this: the market doesn't reward the smartest investor. It doesn't reward the best algorithm. It doesn't reward the person with the best connections or the best education. It rewards the investor who is least forced to act, the one with the longest time horizon, the one with the least pressure, the one with the most conviction. And retail investors have those advantages by default. So here's the final truth about dumb money. It wins when institutions have to behave predictably, and it loses when it tries to behave like them. And if you remember one thing from this entire video, let it be this: unconventional behavior creates unconventional results.